Welcome to the Deep Dive, your shortcut to being well-informed on the latest market movers. Today, we're really digging into the second quarter 2025 results from J.B. Hunt Transport Services. They reported yesterday, July 15th, after the bell, and this one definitely sparked quite a reaction in the market. So let's unpack exactly what happened and why it matters to you.
Absolutely. Yeah, we're looking at how one of North America's, biggest transportation and logistics players is navigating what's still a pretty challenging environment.
Right.
And while their numbers, showed some resilience, there are definitely some critical nuances that caught investors' attention, painted a bit more of a cautious picture, I think.
Okay, so let's cut right to those headline numbers then. J.B. Hunt reported second quarter revenue of $2.93 billion. That just nudged past the consensus estimate, right, which was $2.92 billion.
Yeah, just slightly. And their diluted earnings per share, EPS, came in at $1.31. That was bang on expectations.
Okay, so slightly better top line, flat bottom line.
Exactly. And what's really striking here is that despite pretty solid intermodal load growth that's, using truck and rail together up 6% year over year.
Which sounds good.
It does sound good. But their consolidated operating income, basically their profit from the core business, actually saw a slim 4% decline.
Oof. Okay.
Yeah. And this wasn't because they weren't moving enough stuff. It was largely down to those persistent inflationary pressures. Things like wages, insurance, equipment costs. They're still biting.
So modest revenue beat, earnings just in line, but this underlying cost story. That seems to be the key takeaway that spooked the market a bit.
I think so, yeah. It created a distinctly cautious tone.
Okay, so let's dive deeper into that cost story because it sounds central. Management talked directly about these escalating pressures, didn't they? And they pledged to accelerate a pretty significant cost reduction program.
They did. They've identified over $100 million in annual costs they plan to eliminate. It's a substantial effort.
$100 million. How significant is that for a company this size?
Well, it's meaningful. It's not just pocket change. And it spans three main areas: improving efficiency and productivity, getting more out of their assets using technology, and engineering better processes internally.
Right. But what's the timing on seeing those benefits? Is this like an immediate boost?
That's the key question. Management was clear that while some benefits will be felt this year, the real heavy lifting, the majority of the impact, isn't expected until 2026 and beyond.
2026. Okay. So not a quick fix.
Definitely not. And they emphasize this isn't just about, trimming a bit here and there. It involves fundamental structural shifts.
Like what exactly?
Think leveraging advanced tech like AI to optimize routes, improve network efficiency, better integrating their different business divisions, stuff like that. It's about doing more with less, but they stressed, not through mass layoffs. They're focusing more on reskilling people, shifting them towards growth areas. It sounds like a very intentional, almost cultural evolution.
Interesting. And they hinted this $100 million might just be the start.
They did, suggesting there could be more to come down the line.
Okay, fascinating. So beyond the big cost story, how are the individual business segments actually doing? Let's start with intermodal. That's often a bellwether, isn't it?
It is, yeah. And intermodal, it continued to show strength on the volume side with that 6% growth you mentioned.
Right.
Particularly propelled by their Eastern network, which saw volumes surge 15%.
Wow, 15%.
Yeah. And they're seeing customers actively converting highway freight over to intermodal, which is pretty significant because it's happening even with lower truck rates and fuel prices right now.
That does say something about their service, doesn't it?
It really does. Speaks to their service levels, the cost savings they can offer. Connecting this to the bigger picture, though, while they did get modest rate increases in their latest bid season.
Their first positive pricing in 2 years, I read.
That's right, first positive in 2 years. But they did acknowledge they kind of underperformed their own internal expectations on those rates. However, they seem to believe that the combination of these new rates, plus their cost initiatives, can stabilize intermodal margins. Maybe even support modest improvements from where we are now, potentially even before the next big bid cycle.
So holding the line on margins, maybe improving slightly.
That seems to be the goal. They mentioned getting back to a 10% operating margin for that segment is still the mission through growth, cost control, and pricing, all three levers.
Okay. What about dedicated, the contract services side? How did that hold up?
Dedicated contract services, yeah. Their results were surprisingly strong, actually, especially given how tough the overall freight environment is.
Really?
Yeah, they sold around 275 trucks worth of new deals during the quarter. They say they have a very robust sales pipeline still. And they even got a small benefit from what they call fleet losses rolling into early July. Basically, some trucks came off contract with one customer and were quickly redeployed to new business, helped their Q2 truck count.
So they expect fleet growth in the second half.
They do, yeah. Net fleet growth. Although they caution that some startup costs for onboarding all that new business might temper operating income growth a bit in the near term, but it sets them up well for 2026.
How do we square that strong performance with the general industry gloom?
Well, it really highlights the resilience of that dedicated model, doesn't it? It's less exposed to the volatile spot market. It's more about long-term contracts.
Right, makes sense.
This segment continues to be a real standout for them in this downturn. It's actually operating much closer to its target margin range than their other segments. It's a testament to those integrated partnerships.
Okay, and the brokerage business, ICS. How did that fare?
Brokerage, ICS, yeah. It saw stable volumes, which is okay, but a notable improvement in operating income, mainly due to some pretty deep cost reductions. They took out nearly $10 million in operating expenses, OPEX, year over year, and that builds on a big $35 million reduction they made back in 2024.
So they're getting leaner there.
Definitely. Their customer retention rates are apparently near record levels, too. And they're successfully growing their small to mid-sized customer base that's up 25% year over year.
Okay, so focusing on profitable growth, diversifying. Seems like they're working hard to turn that segment around.
Yeah, make it a more consistent contributor. That seems to be the plan.
All right, one last area before we get to the market reaction. Capital allocation. How are they managing their cash flow, spending, that sort of thing?
Right, cap allocation. Well, they generated over $225 million in free cash flow this quarter. That's pretty healthy.
Decent chunk of change.
Yeah. And what's interesting is they've actually tightened their net capital expenditure outlook for 2025.
Yeah.
Lowered it to between $550 million and $650 million.
Meaning they're spending less on new trucks and things.
Exactly. Largely because they feel they've already pre-funded a lot of their future growth and capacity needs. They bought stuff ahead of time, essentially.
Smart planning, maybe?
Could be. And this financial discipline, well, it allowed them to execute a record quarterly stock repurchase. They bought back $319 million worth of their own shares.
Wow. That's a big buyback.
It is. It's a strong signal of confidence, right? Management basically saying they think the stock is cheap.
Yeah.
And they did all this while keeping a very healthy balance sheet. Their debt leverage is only about 1x trailing EBITDA. That's a very solid financial position to be in.
Okay, so operationally, some strength in dedicated intermodal volumes, okay, but rates, meh. Brokerage cutting costs, financially sound, buying back stock.
Yeah.
But the market reaction, the stock dipped noticeably, you said, on heavy volume too.
It did. Tells you the story pretty clearly, doesn't it? Investors, while they appreciated the stable revenue, sure, but they ultimately fixated on the stubborn cost pressures and the flat earnings per share.
So the promise of future cost cuts wasn't enough for today.
Apparently not. It's that classic market reaction, isn't it? They want the quick fix, not the promise of a long-term diet plan for costs.
Right. And that guidance, suggesting margin repair might gain traction later this year, but freight demand still looking kind of weak? The market saw that as cautious.
Very cautious, yeah. Not a strong catalyst.
Yeah.
And this caution wasn't just JB Hunt. A lot of trucking peers saw their shares trade lower too. Everyone's digesting this sort of lackluster volume commentary across the sector.
It's tough out there.
It is. And remember, JB Hunt was already down about 16% year to date before this. They'd had 3 straight quarters of margin compression. Analysts were cutting targets.
Yeah.
There was a bit of a rally, about 7% going into the earnings print, maybe on some hope for an intermodal upturn. But the fade after the call just shows the market wants more definitive proof of a turnaround beyond just promises about costs.
Makes sense. Did they talk about the relationship between intermodal and dedicated earnings? Sometimes those move differently.
They did, actually. There was a discussion about how those two segments, EBIT, their earnings, had kind of converged. Management was pretty adamant this is just cyclical due to the current weird market conditions, not some permanent structural shift. They fully expect both segments to grow independently again when things normalize.
Okay. And peak season. Are they expecting one? Are they ready?
Well, they said they're prepared for a peak season, but they also noted a lot of uncertainty from customers about forecasting demand.
Ah, the million-dollar question.
Exactly. It sounds like trying to plan a big party where nobody RSVPs properly, the shape, size, duration of peak. It's going to be different for every customer this year, it seems.
So those peak season surcharges they put in earlier, that was more about covering potential volatility than expecting a huge surge.
That seems to be the logic, yeah. Not necessarily banking on a massive peak, but making sure they're covered for the costs if and when demand does pop up unpredictably.
Got it. Okay, this brings us nicely to our "This is not financial advice" segment. Time to pitch an outrageous but plausible trade idea based on everything we've just discussed.
All right, so given the setup for JB Hunt, stock's been beaten down, dipped again after earnings on what looks like cautious guidance. But management is committing to this significant structural $100 million plus cost cut program, mostly hitting in 26 and beyond. And they've already pre-funded capacity for an eventual upturn.
Okay, I see where you might be going.
Here's the idea, and again, purely hypothetical, not advice. Consider a long-dated, out-of-the-money call option on JBHT.
Long date, like how long?
Say, targeting the January 2027 expiry, and a strike price well above where the stock is trading now.
Okay, so an OTM call looking out almost 2.5 years. Explain the thinking.
Right. A call option gives you the right, not the obligation, to buy the stock at that strike price by that date. Out of the money means the strike is higher than the current price, so the option itself is cheaper.
Got it. It's a leveraged bet on the upside.
Exactly. The bet here is that the market is being myopic. It's overly focused on the near-term weak demand and sticky inflation.
And overlooking the compounding effect of those structural cost savings as they really kick in over the next 18-24 months.
Precisely. If the freight market sees even a modest cyclical recovery by, say, late 2026, combined with those efficiencies hitting the bottom line, you could see substantial operating leverage.
Meaning profits could jump significantly on even a small revenue increase because the cost base is lower and the capacity is already there.
You got it. It's basically a play on management's confidence in their long-term earnings power, even while the market is skeptical right now. A bet on patience paying off.
Interesting. Definitely an outrageous but plausible idea there. Okay, let's recap. JB Hunt's Q2 was, well, a mixed bag, wasn't it?
Yeah.
Showed some revenue resilience, but definitely grappling with those stubborn costs.
Yep. And their aggressive $100 million cost reduction plan is clearly the key long-term story to watch, even if the market isn't giving them full credit for it just yet.
Operationally, they still seem excellent. Well positioned for growth in what's a massive $600 billion addressable market. And they continue to return value to shareholders via buybacks.
Definitely. The lingering question for you, the listener, really is, are these long-term structural improvements going to be enough to overcome the current cyclical headwinds? And critically, when will the market start to recognize that potential?
We hope this deep dive has given you some valuable nuggets, some things to think about, especially the implications of these long-term cost strategies in such a volatile market.
And as always, please remember, this is purely for informational and educational purposes. It is absolutely not financial advice. Always do your own thorough research and consult with a qualified financial professional before making any investment decisions.
Thanks for tuning in to The Deep Dive. We'll be back next time with more insights into the numbers that move the markets.